I gotta ask, is the VC model broken? Or do we need a new model? Because does this seem sustainable? Howard, is this, are we gonna come back in a year and think this was a great year?
I do. I think the VC model, the classic VC model is broken. The classic IT-focused VC venture fund. The mathematics are simple. If you raised $1 billion fund and you wanted to return 20% IRR to your investors, you needed to return $3 billion. If you own 20% of your companies that exit, you needed to create $15 billion worth of market cap. If you were in YouTube and Skype and MySpace and a few others, you may be halfway there. There's no way to get there in that old model, particularly without IPO exits being there. So that part's broken. What's not broken is the fact that companies need much less capital. You can build companies now for a few $100,000. As a result, the model that First Round has pioneered in 04-05, which a number of other firms are doing, is much more capital efficient investing in the IT space. Clean tech can sop up all the capital.
The trend, the wonderful trend. Ryan, come in on this topic. I mean, do you agree with what Howard is saying? Is the model broken?
I do. Biasly speaking, though, as a later stage investor, we're very disciplined about how we think about creating enterprise value in terms of where we come in at the purchase price, as well as where we exit. So in Edison's model, we think there's a funding gap between early stage and later stage investors that, priced right and get behind great entrepreneurs, we're typically engaging, let's say, between $3 and $20 million level, grow those businesses to 30, 50, beyond, and sell for a multiple revenue on that. You're still creating venture returns, but we're not putting the fences so far back in terms of what the market cap needs to be that's achievable for all shareholders when we get involved to create venture returns and life-changing events. So we're pretty disciplined relative to that.
Todd, what do you think? I mean, you can look at Vytas when you answer.
Well, I agree with the assessment that the model's broken. The model's broken because venture capitalists are not returning enough capital to their limited partners. If you look, when we raised our first fund, and we raised a very small fund in 2002, we raised $13 million. The average fund from 2002 was returned, I think it's like 30 to 40%. So if you were a $100 million fund in 2002, you drew down that capital over 3, 5, 7 years. By 2010, you've only sent back $40 million. That's just not acceptable. In our fund, we have returned 170% of capital, and it's largely because of what Howard's saying. We're a small fund, putting small amounts of capital into capital-efficient businesses. We don't need billion-dollar exits to have big wins, and most exits in the venture capital business, and this has been really true time immemorial, have been between $25 and $75 million. So we try to figure out a way to make money putting capital into companies that can exit in that range and still make us 3 to 5 times our money, but they have option value. If they're really great companies, they take off and you can make 10, 20, 30 times your money. You still need those exits to generate the returns LPs are looking for. But the way venture capitalists are going about that today is not working. I agree.
Someone who's been a serial entrepreneur, is that foremost in your mind right now?
No, I mean, on every specific deal, you come to the table saying, do I have a value proposition that ought to be valuable to a venture fund? And that means, can I articulate a market big enough that their expectations for exit value will be met, first and foremost? Used to be, that hurdle was very, very high because everyone had these heady expectations 5 years ago that they don't have now, which makes it easier to come to the table and say, look, I've got this business, here's the value proposition, it's in a market that can be, we think, this big, and get a lot of guys to look at us now, whereas maybe before they would have said, 200, 300 million? What are you even here for? We're looking for the billion, $2 billion, $5 billion markets. When you're starting a company, it's great to dream, but you have to actually have a business. You have to be able to say why people will part with their money to buy what you have, and you have to be able to prove that you've made some headway. So the deals that were done on the back of a napkin for ridiculous sums don't seem to be being done anymore, and that helps a company that's got a good model and can articulate it.
It's a little true. One of the things we like to talk, we mentioned that Kleiner Perkins had a huge fund, a $1 billion fund in 2000, a little before actually. It returned 3.1 billion, 3.5 of which was Google.
David, you have that in the chart, and that must have skewed some of the numbers.
We recently had a really nice exit at a West Coast company of ours called Mint.com, which we went into at the very beginning in well under 10 million, which is where we go in, and we sold into it for 170 million. It was a fantastic return for us. It had made one of our funds return 170% of its capital. One of the later stage investors who would come in a little bit later said, I can't deal with wins like this. Because I can't return my fund if I have wins like this. So they really do have that change. We do look at, as Vytas said, we do look for companies that will exit in a normal M&A exit environment between 50 and 125 million. We'd love to take them to $1 billion. Those are rare events, really rare events. You have to be able to build a business around investing in things that you can exit cheaper.
Brian, is this a case of smaller being better, or do we get to be cynical and just say it's just smaller? Let's not figure out how to make it better. It's just going to be smaller. We're going to have to learn to live with this.
Not necessarily. We would argue you're actually mitigating some downside risk in our model and still have the ability to return earlier stage returns. And there's an arbitrage a little bit relative to taking on greener teams in terms of backing them, productizing service-based business models that we have somewhat of a specialty in doing, and getting behind cash flow disciplined entrepreneurs that are going to manage the investment once in and really scale it up without taking the dilutive impact of multiple rounds. So we think that we can create venture-type returns with less than 10 million of capital put in and stay disciplined around that. If we get to a point where we're able to build a $50 million business and we feel the market can support a much larger company, $100 million plus, we're the first to say, let's double down and go for it. But unless we have the proof points, we're not going to get behind it or support that until those goals are aligned between the entrepreneur as well as us. Ryan,
do I sense an angel somewhere in the back here? I mean, is there an angel looking over an investment like this?
It's more rarity than not in all candor. But you know, in each of our funds, to give you some statistics, we've invested in 170 companies, 60 active presently right now. And every single one of our funds, we're on Fund 6, there has been at least 3 10-times winner in the model that I described. So the venture economics still are there in later stage firms, but can we create billion-dollar outcomes? That's very rare, and we see